from Bloomberg's Washington Bureau to our TV and radio audiences worldwide. I'm Kevin Cirilli.
And from Bloomberg World Headquarters in New York, I'm Vonnie Quinn. Welcome to Balance of Power, where the world of politics meets the world of business. Let's start with the markets today. Some very major news to digest over the weekend. Abigail Doolittle is here. So we had the phase one completed.
Yes, we have the phase one completed, although it hasn't been signed. So that is possible one nuance. But this year, we just have stocks off to the races, climbing that wall of worry. Today, another set of record highs for the major averages here in the U.S., plus lots of the sectors, including the financials, which until last week hadn't put in an all-time high until 2007 since the financial crisis. So investors looking right past the trade concerns that there had been, impeachment, the economy, and behind all of this, Vonnie, looking back in early January, Fed Chair Jerome Powell, he went slightly dovish, and that seems to have created this lift. Right now, the S&P 500 up more than 25% on the year, headed to its best year since 2013.
Of course, we got rid of a lot of things. We got plenty of high-frequency data that we were waiting for, like the jobs report, the ISM data, the consumer data.
Yes.
There wasn't really much to dampen spirits. But, for example, the SOX index, why is that rallying so much today?
Well, that has everything to do with trade. Well, it has mainly to do with trade optimism, because most of the revenues for the chip companies coming from China, or a good portion, the supply chain. But another thing there, that sector had been in a bottoming phase on memory pricing and some other demand issues. So investors very hopeful that the all-important chips are coming out of that bottoming phase and buying in, plus 5G. If 5G goes ahead, that's going to create a major upgrade cycle, which should really help those chip companies. However, it does look a little bit frothy, so it's important to keep that in mind, too. Are investors getting ahead of themselves? Something also to keep in mind with all of this buying, last year was a bad year for managers. So at this point, as we go into the end of the year, you have to think managers want to lock this one in so that they can have a good year after a bad year.
All right, and quadruple witching this Friday as well, of course.
Could be volatile.
Abigail Doolittle, thank you. Kevin.
The volatility never stops. Now to this week's historic vote on impeachment. Let's bring in our political panel of Genevieve Wood, senior advisor and spokesperson for the Heritage Foundation, and up in New York is Basil Smikle, former executive director of the New York State Democratic Party. All right, Genevieve, I'll start with you. In terms of impeachment, in terms of the Senate, is Leader McConnell going to be able to strike a deal on rules with Senate Minority Leader Chuck Schumer?
Well, they're going to have to, but at the end of the day, I mean, the Republicans are in charge in the Senate. So I think Senator McConnell, it's going to go the way that he wants it to go. He's going to have to bring some of the Democrats along, but I think you're going to see McConnell leading the charge here.
Basil, to flip that question, Wednesday is when we're anticipating this historic vote in the House of Representatives on impeachment. I've got my eye on 31 members, 31 Democrats who flipped the 2016 congressional districts that went for President Trump and then were able to win them for Democrats. How is this going to play in those 31 districts?
Well, it's going to be difficult for a lot of those members. If you remember when Democrats ran in 2018, we ran these very hyper local races, tried very hard not to nationalize these races, and that's what helped us take back the House. It's going to be very difficult to do that when all of these members have to take a formal vote for or against impeachment. So I think it's going to behoove all of those 31 members, for example, to pivot very quickly back to a policy discussion when they're in their individual districts. But it's not something that they're really going to be able to navigate away from. They're going to have to deal with it in some way, shape, or form. And I expected that a few members would vote against impeachment. And I think Nancy Pelosi is anticipating that as well. You're not going to see as hard a line on the Democratic side as you have on the Republican side. But that's okay. I think at the end of the day, that's going to be okay to keep the majority held.
We're just getting word that Senate Democratic leader Chuck Schumer will be holding a news conference at 2 p.m. Eastern, so maybe we'll hear more at that point. What happens to legislation? So while this is going on, do we get the signature of the USMCA?
Yeah, I think we do, and I think we actually have to, because that is one of the big policy positions that Democrats can take some credit for. There's some discussion also about paid family leave, which is very, very important for a lot of these members. So yes, I think we do get that deal. I think we have to pivot very quickly back to policy.
What happens to senators that are campaigning? So obviously January is going to be a really busy month for those.
Right.
And before we get to the polls now and what's actually happening, what do those senators do, Basil?
Well, you know, it's going to be interesting because you've got Cory Booker is not on the debate stage, for example. Kamala Harris is not running anymore. But you've got people like Michael Bennet, Elizabeth Warren, and Bernie Sanders. This is going to become a substantial part of their talking points as we get into this primary season. They will have to come away from the field considerably, but I suspect they'll be just as strong when they go back out there and talk about why they had to vote the way they did to get rid of this president, even if at the end of the day he doesn't get convicted.
And I'll be headed out to LA later this week for continuing coverage of that debate. But Genevieve, I want to stick with impeachment for a second. In terms of the Republicans, Senator Susan Collins, Senator Mitt Romney, you know this, all of the attention is going to be on some of those Republicans in the Senate, in the upper chamber, who have been very critical of President Trump and how he's handled this impeachment. Is there room in the Republican Party for a Republican senator to vote to convict President Trump?
I think it'd be very difficult for them to explain that vote to most of their constituents. Look, you can not like the way things have been handled, but the question is, do you think it reaches the level of impeachment, and do you think he should be convicted? And I think that's the question that Senator Collins and Mitt Romney, who may not like some of the way that the president has handled the situation, they may not like it, but can they go to the level of impeachment? I don't think you're going to get there. And look, to this whole thing, I think the Democrats eventually would like some of this to go away, because as you were just discussing, many of their candidates are going to be taken out of the Senate if the Senate goes on with a full trial, which I think the president has said he would like, because he wants to try to clear his name on this and really show that he did nothing wrong. So it's going to be interesting to see if they go full blown with the trial, or if they go the other direction, which Lindsey Graham wants to do, of saying, let's just get rid of it altogether. That's going to have a big impact, I think, on Democrats in many ways, even more so than Republicans.
Briefly, Basil, I just want to ask you about Amy Klobuchar, because there's been a lot of chatter recently about how, Iowa is taking another look at her, and the race is obviously still so fluid. What do you make of it? What happens in Iowa? It
is anybody's race at this point, and for a lot of folks that have come in as of late, including Deval Patrick, Mike Bloomberg, I think they're waiting. They're saying, if no one runs the table in these early states, then Super Tuesday is where we make our stand. And it's true. I think a quarter, a third of all the delegates available are up on Super Tuesday. So those early states like Iowa are great for a media narrative, but in terms of the actual delegate count, it's actually a very small percentage. So I think it's anybody's race. And I'm happy to see that Amy Klobuchar is challenging the leadership, the top tier for Iowa, because she actually has a lot going on for her, and we haven't heard as much as I'd like.
Our thanks to our panel. Our thanks once again to Genevieve Wood in Washington and Basil Smykel here in New York. We turn now to Mark Crumpton for the Bloomberg First Word News.
Vonnie, a House panel says President Trump betrayed the nation for his own political gain. The House Judiciary Committee has released a 650-page report detailing its rationale for impeachment. The president faces 2 articles of impeachment by House Democrats: abuse of power and obstruction of Congress. The House will vote Wednesday. The vote is all but certain to result in President Trump's impeachment, though he's expected to be acquitted in a Senate trial. The president's expected to announce an American troop drawdown from Afghanistan as soon as this week. Speaking from Kabul, South Carolina Republican Senator Lindsey Graham said the drawdown could begin before the end of the year. He said Afghanistan's national security forces are up to the task of defending their country. Still, Graham has opposed a full U.S. troop withdrawal. In France, transport strikes against a planned overhaul of the pension system continued for a 12th day. Authorities measured a record traffic jam of 391 miles of traffic in the Paris region, where only 2 metro lines using automated trains with no drivers were fully running. Most regional and national trains were still at a standstill. French President Emmanuel Macron has proposed raising retirement age to 64 and ending special privileges for some workers. British Prime Minister Boris Johnson's government will introduce its Brexit bill to Parliament this Friday. The Prime Minister won't have a problem getting a mandate to ratify the divorce deal. The question is whether the government can get the bill to a vote this week instead of having to wait. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Vonnie?
Mark, thank you. Well, speaking of Brexit, the Bank of England just out with its latest financial stability report. In it, it's recommending tighter rules for open-ended funds. It's also going to raise the countercyclical buffer to 2% in a year. That's up from 1%. We'll get the results of bank stress tests and much more on this in a few moments. We're going to be hearing as well from Bank of England Governor Mark Carney. That's at the bottom of the hour. First time since the general election. This is Balance of Power on Bloomberg Television and Bloomberg Radio.
Phase one is going to be implemented right down to every detail. It really is a remarkable agreement, but it's not going to solve all the problems.
U.S. Trade Representative Robert Lighthizer speaking on CBS's Face the Nation there on the Phase 1 trade deal that the U.S. just reached with China. Joining us now with reaction to this and more from West Des Moines, Iowa is Tom Vilsack. He's the president and CEO of the U.S. Dairy Export Council, of course also former Agriculture Secretary and former governor of Iowa. And welcome, Tom. How are your members reacting to this Phase 1, even as we await really clear details on it?
Well, I think it's a wait-and-see situation right now with China and the deal. As they say in trade, nothing's agreed to until everything's agreed to. With China, nothing's agreed to until everything's implemented. And I think Ambassador Lighthizer was right when he suggested that the key here is whether or not China will actually follow through with the agreement. For dairy, there may be opportunities. We just don't know. It appears as if there may be some sanitary and phytosanitary barriers that may be removed. But again, with China, you have to actually see them in action before you can determine whether or not it's going to be a good deal or not.
So we're pressing pause on reaction there, but we can react perhaps a little bit more to the USMCA, even though it also hasn't been signed yet, but at least there is a framework there. How are your members reacting to the idea that exports to Canada are now given a green light?
Well, they're excited about the opportunity that the USMCA presents in terms of new market opportunities in Canada and an elimination of the Class 7 discriminatory pricing system that has distorted powder prices throughout the United States and throughout the world. They're also excited about the opportunities that the new Japan agreement has created for dairy to reopen and to re-engage in that market as well. So in terms of short-term opportunities, I think the USMCA and the Japanese agreement are where we're focused. If something gets worked out with China and it in fact results in additional sales, that's all to the better.
Well, I want to go right back to China, to that point precisely, because you alluded to this, but nothing in the framework that we've seen and the reports that we've seen of Phase 1 of U.S. and China points to enforcement mechanisms. How will this be enforced, or do you still need more answers on how this will be enforced?
I think we have to take a look at the actual details of the agreement once it's signed and once it's released. There has been discussion about the possibility of re-engaging in terms of the tariffs being re-engaged or increased or reestablished. That may be an enforcement mechanism. I think Ambassador Lighthizer at one point indicated that might be the way in which you would enforce this agreement. But clearly there has to be an enforcement mechanism because the Chinese are famous for agreeing to quite a bit but never following through and delivering on their agreement. So that's why there's a wait-and-see attitude on this particular agreement, especially as it relates to dairy.
As we look into next calendar year, does the Phase 1 suggest that Phase 2 might not happen in 2020 and might have to wait till 2021, or is there anticipation that Phase 2 will begin in next calendar year?
You know, I think Phase 2, if it really involves a fundamental change in the way in which China does business with the rest of the world, is going to take a considerable amount of time, and it may take more than just the United States raising these issues. The reality is that many countries get mistreated by China in terms of investments in China, the intellectual property issue that was also raised. So I think it's going to be incredibly important for the U.S. to work with the rest of the world to go to China if we're going to see fundamental change in the way in which China does business within China.
So for the moment, your farmers are looking north and they're looking south. Tom, we are in year 4 of milk drop in prices. It's been pretty chronic for those dairy farmers. Will this USMCA deal give them some relief? Does Canada need or want the milk that it can now receive?
Well, a combination of the good news with the USMCA, the Japanese agreement, We have seen an increase in exports, an increase in the value of U.S. exports in terms of dairy. And so we've begun to see an increase as well in the price that farmers are receiving. So perhaps some relief from the difficult times over the last couple of years is certainly occurring in 2019, and we expect it to continue in 2020. And I think, again, additional market opportunities in Canada. When Class 7 goes away, that should stabilize powder prices, putting us in a better position. And the new opportunities in Japan certainly bode well for 2020.
Tom, I have to ask you about your state. You're a supporter of Joe Biden. He has been struggling a little bit in Iowa. I'm curious as to how a Democrat wins what's been tending towards red in terms of Iowa in recent times.
Well, I think for Democrats it's important, and I think Democratic candidates, including Vice President Biden, have done a good job of reaching out into the small communities that dot the landscape of my state. 850 communities in our state have populations of 1,000 or less. And it's important for Democrats not only to show up in those communities, but also to be able to talk specifically about rebuilding and revitalizing a rural economy that's seen some very difficult times, especially the last couple of years. I'm pleased with Vice President Biden's plan to rebuild the rural economy. Other candidates have also put forward comprehensive plans. So I think we're going to get a better messaging to rural Iowa, which I think should shrink the margins and put us in a competitive circumstance in November of 2020.
Tom, thank you for your time today, and congratulations on what looks to be a good time ahead for farmers. Tom Vilsack, CEO of the U.S. Dairy Export Council, former Agriculture Secretary, of course, and Governor of Iowa. Kevin.
And still ahead, we're going to stick with Iowa because the chairman of the Senate Finance Committee, Senator Chuck Grassley, Republican from Iowa, his views on the China deal, impeachment, and more. This is Balance of Power on Bloomberg Radio and Bloomberg Television.
This is Balance of Power on Bloomberg Television and Bloomberg Radio. I'm Vonnie Quinn.
And I'm Kevin Cirilli. Joining us now from Capitol Hill is Senator Chuck Grassley, Republican of Iowa and chairman of the Finance Committee. Chairman, thank you very much for being here.
Glad to be with you. Thank you for having me.
And we'll jump right into it. I mean, we were talking earlier about the USMCA and its likely ratification. I mean, how much of a win is this for farmers in your state?
Very good, and I probably will be duplicating some of the things that my friend Governor Vilsack told you, but very good for dairy products into Canada, very good for our quality wheat into Canada. We've been blocked out of that for the last quarter of a century or 3 decades, so that's a big move. The other thing is what it does for employment. In rural America, we have a lot of component part manufacturers for automobiles in Iowa, and a lot of those may have farmers that also work in town. I know there's a lot of that goes on in my state of Iowa. Those workers will be enhanced as a result of this treaty as well.
Mr. Chairman, on one hand, you've got USMCA. On the other hand, you have the U.S.-China Phase 1 deal. Suggestions that there's going to be massive more agricultural purchases made. How's that going to impact you? And are you skeptical at all about how the Phase 1 is going to be enforced?
Okay. Well, first of all, last Friday was a very big day for the President of the United States. That is the first president in a long time making trade, unfair trade, the issue that he ought to make it. And I think he had 2 big accomplishments last week. You know, we talk about intellectual property, trade secrets, not manipulating their currency, transfer of technology to China. Those things are going to be a little harder to measure. But to answer your question, when China says they're going to buy to $40 to $50 billion of agricultural products, that's going to be easy to measure. So we're going to know pretty soon whether or not they're taking that secret, if taking that to heart. So let's go. Another agreement that was made, announced Friday, is that there's going to be a state-to-state intervention by the American business in China, including our agriculture products, if we aren't treated fairly, that there's going to be a consultative process that doesn't exist today, where U.S. businesses and farm groups can complain to the USTR here in Washington, D.C. can intervene for them with the government of China.
Senator Grassley, how close is Mitch McConnell to setting the rules for impeachment and how it progresses in the Senate?
Okay, obviously I can't answer for sure, but I can say you what the process is going to be. And how far down this process, I don't think we're very far yet. But there's going to be a great deal of consultation between McConnell and Schumer to see if what happened in the Clinton administration can be repeated for this impeachment. And that was a vote of 100-0. In other words, complete bipartisanship on how you ought to proceed. Those talks will have to go on between McConnell and Schumer. And then if those are not fruitful, assuming Republicans have a majority, and we have 53, but we got to have 51 votes to accomplish this, we may have to go ahead on our own. But that's not the way McConnell wants to do it. McConnell wants it to be very smooth as it was back in the Clinton impeachment.
And briefly, Senator, when does USMCA get signed, given that this is about to start?
I would guess from my talks with McConnell that it'll be up immediately after the impeachment is over. In other words, the president's guilty or not guilty. And there's a feeling that they haven't made a very good case yet, so he may not be guilty. It could still take a long time to make that determination, but when that's over, we will take it up, and there's a limit of 20 hours of debate, and it can pass with 51 votes, so we don't have to worry about getting a supermajority. We don't have to worry about cutting off a filibuster.
Senator, thank you for joining us today. That is Republican Senator from Iowa, Chuck Grassley. This is Balance of Power on Bloomberg Television and Bloomberg Radio.
This is Balance of Power on Bloomberg Television and Radio. I'm Kevin Cirilli.
And I'm Vonnie Quinn. For Bloomberg First Word News now, we go to Mark Crumpton.
Vonnie, Kevin, the impeachment vote this week in the House is a crucial test for more than 24 vulnerable Democrats. They represent districts that President Trump won in 2016. A number of them say they still haven't decided how they'll vote. The Democratic majority in the House hinges on keeping those Trump-leaning districts in next year's election. Canadian Prime Minister Justin Trudeau is beginning his second term with his country's finances in much worse shape than expected. And that's even before the governing Liberals move ahead with tens of billions of dollars in new campaign pledges. New budget estimates released today by the government show Canada is currently on track to run a deficit of about $20 billion this year. Deficits between 2019 and 2023 are expected to exceed projections by more than $26 billion. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Vonnie?
Mark, thank you. Bank of England Governor Mark Carney holding a news conference now, the first post-general election. This after the BOE published its financial stability report. Let's listen in.
To increase the supply of productive finance. And today's financial stability report provides an example of each of these. So I'll start with issues that relate to addressing near-term risks, and beginning with the banking sector. The 2019 stress test published today shows that the UK banking system would be resilient to an unprecedented combination of simultaneous recessions in the UK and global economies that are more severe than those experienced during the global financial crisis, large falls in asset prices, and a separate stress of misconduct costs. All 7 major banks and building societies in the test can not only withstand these extreme shocks, but also continue to meet the demands for credit from UK households and businesses. In part, that's because their capital ratios are currently over 3 times higher than they were at the start of the global financial crisis. Even after stress, their capital ratios would still be more than twice their pre-crisis levels. Banks' resilience in the test relies in part on their ability to cut dividend payments, reduce employee variable remuneration, and cease coupon payments on additional Tier 1 instruments. If banks had not cut such distributions during the stress, they would not have, in aggregate, met the 2019 hurdle rate. This demonstrates the flexibility of the system, but it also underscores that investors should be aware that banks would make such cuts as necessary if a stress were to materialize. Turning to Brexit, the MPC will provide a high-level update on the UK's economic prospects this Thursday. The FPC's job is to focus on and prepare for worst-case downside risks, including those that could be associated with disorderly forms of Brexit, however unlikely. The FPC continues to judge that the financial system is ready for Brexit, whatever form it takes. And reflecting extensive preparations made by authorities in the private sector, most risks to UK financial stability that could arise from disruption to cross-border financial services in a no-deal Brexit have been mitigated. And in particular, the FPC welcomes the European Commission's decision to extend the temporary equivalence arrangements related to UK CCPs. Turning to structural actions to improve resilience and increase productive finance. Stepping back from current risks, so looking at the structural issues and reviewing the structural level and the balance of capital requirements with the UK banking system, the FPC, together with the PRC and the bank, have made the following determinations. The FPC is raising the level of the UK countercyclical capital buffer, or the CCYB. We're raising that rate that it expects to set in a standard risk environment from the region of 1% to the region of 2%. And since we are in the standard risk environment, in our judgment, the new 2% UK CCYB rate will take effect in 1 year. Reflecting the additional resilience associated with higher macroprudential buffers, the PRA will consult next year on proposals to reduce minimum capital requirements in a way that leaves overall loss-absorbing capacity in the banking system broadly unchanged. The Bank of England is also clarifying that, in the event of a bank resolution, it expects all debt that is bailed in to be written down or converted to the highest quality of capital, or Common Equity Tier 1. These changes, taken together, increase the resilience of the system by shifting the balance of loss-absorbing capacity towards higher quality Tier 1 capital, while leaving the overall loss-absorbing capacity for the banking system broadly unchanged. Tier 1 capital requirements for major UK banks will remain in line with the benchmark level first set by the FPC in 2015. That level was 14% of risk-weighted assets. That benchmark balances the need for banks to be able to keep lending during downturns with the need for them to provide finance to support growth over the medium term. These changes improve the responsiveness of capital requirements to economic conditions by shifting the balance of capital requirements from minimum requirements that must be met at all times towards buffers that can be drawn down as needed. For example, if the UK CCYB rate were cut from 2 to 0%, this would enable banks to absorb up to £23 billion of losses, preserving up to $500 billion of banks' capacity to lend to UK households and businesses. A higher setting of the UK countercyclical buffer in standard conditions will also allow the FPC to pursue a gradual approach to raising the buffer as risks increase. And finally, these changes enhance the resolvability of failing banks by the Bank of England's intention to write down or convert debt to CET1 capital. This will make banks more resilient to future losses, supporting their resolution and minimizing wider economic costs of their failure. Turning to the mortgage market, the FPC has reviewed its mortgage market recommendations, namely a 15% limit on the amount of new mortgage lending at or above 4.5 times the borrower's income, and its recommendation that lenders assess whether borrowers could meet their mortgage payments if interest rates rose by 3 percentage points. Mortgages are the largest financial liability of households and the largest loan exposure of lenders. In the past, as an economic expansion has progressed, lenders' underwriting standards have often shifted from responsible to reckless, leading to a significant increase in highly indebted households. As a consequence, these households are likely to face greater difficulties and can cut back more sharply on their spending to make their mortgage payments. This in turn deepens the recession and worsens the impact on the wider economy. The FPC's tools maintain financial stability and support economic growth through the cycle, providing benefits that substantially outweigh the macroeconomic costs. Alternatives to achieve similar benefits would be much more costly to the wider economy. For example, without the FPC's insurance policies, monetary policy would have to be tightened significantly to address the financial stability risks of deteriorating underwriting standards and rapid credit growth. This would reduce jobs and growth across the economy. Alternatively, in the face of looser underwriting standards, banks would be required to have materially higher capital ratios. This would raise the cost of credit for everyone. The FPC has therefore judged it's appropriate to maintain both recommendations and that these structural measures should remain in place through the housing cycle. Turning to LIBOR, continued reliance of financial markets on LIBOR poses risks to financial stability that can only ultimately be reduced through a transition to alternative risk-free rates. Accordingly, the intention is that sterling LIBOR will cease to exist after the end of 2021, and no firm should plan otherwise. There are encouraging signs in sterling markets, and the FPC endorses the UK Industries Working Group's target to cease new issuance of cash products linked to sterling LIBOR by the third quarter of next year. And the FPC agrees with the PRA and the FCA that the largest regulated firms with material LIBOR exposures should have a senior manager responsible for the transition. But gaps remain, and efforts will need to accelerate in the first half of 2020. And to that end, the Bank of England is currently reviewing its risk management approach to LIBOR-linked collateral delivered in its sterling monetary framework, and the FPC is considering further potential supervisory tools that could be deployed by authorities to encourage the reduction in the stock of legacy LIBOR contracts to an irreducible minimum ahead of 2021, and will keep them under review in light of progress made by firms in the transition. Turning to the promotion of productive finance, the mismatch between the redemption terms and the liquidity of some funds' assets means there's an advantage to investors who redeem ahead of others, particularly in stress. And this has the potential to become a systemic risk, as first-mover advantage could prompt a destabilizing rush to the exits. As part of the ongoing review of open-ended funds by the bank and the FCA, the FPC has established that there should be greater consistency between the liquidity of a fund's assets and its redemption terms. Specifically, the liquidity of fund assets should be assessed either as the price discount needed for a quick sale of a vertical slice of those assets, or the time period needed for a sale to avoid a material price discount. Investors who redeem should receive a price for their assets that reflects the discount needed to sell the required proportion of a fund's assets in the specified redemption notice period. And redemption notice periods should reflect the time needed to sell the required proportion of a fund's assets without discounts beyond those captured in the price received by redeeming investors. In addition to enhancing financial stability, these changes are expected to promote the overall supply of productive finance to the economy through the business and financial cycles. They will enhance both the ability of funds to invest in liquid investments and increase investment in funds with longer redemption terms. Turning to payment systems, innovation in payments could bring significant benefits to users, including lower costs and faster processing times. At the same time, the ability to transact safely and smoothly is critical to financial stability. And the FPC considers that the current payments framework will need to be adjusted to accommodate new innovation along the following principles. Regulation of payments should reflect the financial stability risk rather than the legal form of payment activities. Secondly, the systemic importance of any single firm should be informed by whether its failure could disrupt one or more end-to-end systemic payment chains. And thirdly, all firms above a certain threshold carrying out the activities that make up a payment chain should provide sufficient information to support the identification of systemically important payments firms as they emerge. Stablecoin-based payment chains, such as Libra, pose additional issues for regulation. Payment chains that use stablecoins should be regulated to standards equivalent to those applied to traditional payment chains. Where stablecoins are used in systemic payment chains as money-like instruments, they should meet standards equivalent to those expected of commercial bank money in relation to stability of value, robustness of legal claim, and the ability to redeem at par in fiat currency. To conclude, as the latest stress test indicates, the core of the UK financial system would be resilient to the crystallization of a number of current risks, ranging from abrupt changes to trading relationships, sharp movements in asset prices, and deep economic downturns. Such near-term preparedness is an essential part of the FPC's job, but it's only an element of its responsibilities. We're also working to improve the structural resilience of the banking sector while increasing its responsiveness and resolvability by reforming bank capital standards. We're continuing our mortgage measures in order to provide insurance against the encroachment of irresponsible lending standards that have in the past contributed to painful recessions. And we're supporting efforts to replace LIBOR, to reform open-ended funds, and to oversee new payment systems in order to ensure that more sustainable and resilient productive finance is widely and reliably available. Through all these actions to reduce risks to financial stability and to improve the financial system, we're doing our part to promote the good of the people of the United Kingdom. And with that, Sam, John, and I would be very pleased to answer your questions.
Okay, wait for the mics. Can you please give us your name and organisation? And please, one question each first time around. Simon, and then Ed up there.
Thank you. Simon Jack, BBC News. Governor, have you reviewed or changed your view at the FPC of the risks posed by a disorderly Brexit, given the events of the last week?
We have, so as I said in my opening comments, and it's indicated in the report, our job is to look at the worst case scenario. So the worst case scenario is effectively a no-deal disorderly Brexit. The probability of that scenario has gone down because of the election results and the intention of the new government. But the scenario itself and that which the risks that we protect the system against has not itself changed. It's just become less likely. So the tail risk against which we have insured has become less likely. But I think what you would expect us to do, and what people would expect us to do, is to continue to ensure that the system is ready so that the financial system is not forming a constraint to whatever negotiations are underway or discussions are underway, but is part of the buffer for whatever happens. But yes, the probability clearly has gone down.
Ed Conway from Sky News. It kind of building on what Simon's asking. So one of the phrases that keeps coming up a lot in the FSR is Brexit-related uncertainty. And so what is your sense? I mean, you're going to talk to the economic implications in the MPC minutes later on this week, but what's your sense of what this implies for the financial system? And are you getting already a sense from what markets are doing in the last day or two that tells you whether that uncertainty is diminishing?
Well, the markets are reassessing a host of political uncertainties, potential policy paths for the UK, and probabilities around Brexit, and they'll make their judgments. Again, from the FPC's perspective, Ed, what we have to do and what we have been doing is preparing for that worst-case scenario. Until we have a deal, and a transition to that deal, we'll continue to have arrangements in place, whether they're additional liquidity, ensure that the capitalization of banks are consistent, or arrangements such as the temporary but important cross-border arrangements that have been put in place around the derivative markets, which are the product of discussions with ourselves and European officials, as a bridge to the final relationship. And we'll just continue to ensure against that tail as the country moves forward. Thank you.
Okay, Brian, and then Ben.
Hello, Brian Swint from Bloomberg News. Assuming that Brexit goes through on January 31st, as the current government policy is, do you still have Brexit risks in your stress tests for next year, or do they morph into something else?
Yeah. So just to be absolutely clear, in this stress test, we didn't have Brexit risks per se. We did. So what we had in the so-called ACS stress test, which we run over the course of the last year, is we had a very severe global downturn, including quite substantial outright recession, outright negative growth in China and in Hong Kong. Sharp falls in asset prices, a big stress on misconduct costs, which are above and beyond the misconduct costs that UK banks have experienced over the course of the year, and then independently a sharp recession in the United Kingdom, including with unemployment going up 9%, interest rates going up by several percentage points, and on and on and on. GDP down by more than 4 percentage points. That wasn't a Brexit stress per se. We had, if you recall, about a year ago at the request of the TSC, the request of the TSC, we revealed a separate Brexit analysis that we had been doing because we had wanted to make sure that these severe stress tests encompassed what could happen if we had a Brexit stress, but not just a Brexit stress, in other words, a disorderly Brexit, but also at the same time, for example, a trade war and a sharp global downturn so that the system could withstand both of those events, and on top of that, a bigger increase of misconduct costs. And the judgment, it was revealed this time last year, was that that was indeed the case, that Brexit was less severe, a disorderly Brexit was less severe in aggregate than the stress that we are subjecting the system to. So we will, the committee will finalize its judgment on the type of stress that it will run next year. And we're in current discussions on that, so I can't say exactly what that would be. But what you would expect, it would be somewhat different from the type of stress that we have in the past, because recall, the banks change a bit with time, but they don't change that much. And so we've run a couple of years of a certain type of stress, which gives us the confidence that we're encompassing, if I can use that term again, encompassing Brexit plus other risks. And so naturally, I think the committee will want to look at different types of risks for the 2020 stress.
Ben Martin from The Times. Can I ask, have the bank put in place any contingency measures in case of a market sell-off if there had been a Labour majority in the election?
We didn't put any special contingency measures in place. We've had contingency measures in place for the possibility of a no-deal, disorderly Brexit. Most importantly, the PRA supervisors have been monitoring liquidity and liquidity positions in aggregate of the major banks and building societies, but also the foreign exchange liquidity positions of those institutions. That's been running for quite some time, actually, because as you'll recall, Ben, we've had a series of potential cliffs over the course of this year, and we were potentially heading to, I mean, technically we still are, but potentially heading to another one at the end of January. So all of that was in place, and it goes to a more general point, which is that part of the value of stress testing and contingency planning is that it also prepares you for things you don't necessarily expect, or other, events can happen, financial stability events can happen, and over time, as we look at different scenarios, as we prepare for different events, as the banks themselves prepare for this and think about different scenarios, the risk that eventually comes may be entirely different, may have a different genesis, but that preparation will at least be helpful in that circumstance.
Okay, Tim, and then Oscar behind him.
Thank you. Tim Wallace at The Telegraph. Governor, if Brexit now, or if a disorderly Brexit is now a lower probability event, what do you see as the most significant risk facing the UK's financial system after that?
Well, there's a host of there are a host of global risks. So the global scenario we have, which admittedly is quite severe, but what is one which is could be triggered by a deepening of the fragmentation of the global trading system, sharp, certain geopolitical or political events beyond our shores. We do see that we're conscious of medium-term risks from indebtedness, corporate indebtedness and household indebtedness in general. We are reassured by a couple of things in the UK, which is first that the underwriting standards have held in, not just on mortgages, in part because of the mortgage measures, but also on consumer credit, where the PRA has been active and overseen that, and those have stabilized. The underwriting standards have stabilized there. But we're also, I would say, reassured that UK households in general have been, they have paid down debt. They've worked hard and paid down debt, at least in relative terms, and they are in a better position. But what you do in those circumstances is to make sure that you have the appropriate buffers in that environment, so that if risks start to build, we can act in a timely fashion. If I may just make a short commercial for the CCYB change for the countercyclical buffer, part of the reason to move it up to that level of 2%, which doesn't result on average in much of a change in the overall loss absorbing capacity, but it puts us in a position that if risks were to start to build, we could more readily get the buffer to a level that would make a material difference if we had the type of buildup in risks that we've seen in other more extreme risk environments. But do you want to add anything on that?
No, say on the raising of the CCYB in a standard risk environment, 2%, and there's some material actually in the FSR that if, for example, you look back at the crisis and pre-crisis period, the indicators didn't really start moving until 2004, 2005. So if you wait until you start to see the indicators of risk moving significantly, then there may not be time to move gradually. So if you can transfer loss absorbency to buffers in the way that we're doing, it actually means you could get to the level that you would need to get at the peak of the crisis. I think the estimates are we'd have needed a CCYB between 3.5% and 5% by the time we reach 2007, 2008. This gives us a chance to move gradually towards that, given that often the indicators don't move until a few years beforehand.
Yeah.
Oscar Group, leveraged loan losses are up in this stress testing. How concerned are you at the rising level of leveraged lending and also the declining standards within that sector?
Yeah, well, let me start, and then I'll ask Sam to expand. I mean, we're concerned to the extent when we look at, and it goes back to Tim's question, where do we see pockets of risks or sort of emergent areas of risks? And the sharp buildup in leveraged lending, particularly into the United States, so the releveraging of corporate America is an area where we do see, there's been a steady buildup of risk there. And so the quality of those loan books has deteriorated. And that's part of the reason why we've spent as much time as we have in the last couple of years to determine, is to try to follow the money. So where is the actual exposures that, recognizing these are largely exposures to the U.S., I'm oversimplifying, but largely to the U.S., and so which institutions have which types of exposures and how big are they relative to the size of their capital bases. And then we've subjected them to a more extreme...
You've been listening to the Bank of England Governor Mark Carney. Our TV viewers will continue with that. For our radio listeners, we'll pick it up with Balance of Power. You're listening and watching to Balance of Power on Bloomberg TV and radio.
Dig into it a bit.
Okay, so just to add a bit more colour on the UK banks themselves, so the total exposures to the leveraged loan market as we define it for the UK banks are around 90 billion. Which is just slightly less than half of their common equity tier 1 base. So that is obviously material. And as the governor was saying, we've dug deeper into those this year, and you need to think of them as being in 3 buckets. There are revolving credit facilities, which we've stressed to an impairment rate of sort of 11 or 12%, which is higher than what they experienced in the global financial crisis, but we think that is reasonable given the different interest rate path that we have.